So I think you can start.
Sure. So a great evening to all. It's a moment of immense pride and privilege for me to welcome such enthusiastic audience on behalf of Bahrain chapter of ICAI. As your MC of the day, this is Ankur Gupta. I'm quite excited to walk you all through this enlightening event. Just a few housekeeping rules before we get started. Please mute your mics during the session if you are not the speaker. If you have any questions during the presentation, kindly type them into the chat box. I shall address it at the end of the presentation. At the end of the session, we will have a Kahoot quiz by CA Natasha. So I would request all members to download the app on their cell phone if it is not already downloaded. So to begin with, let me call upon our very dynamic chairperson, CA Ajay, to deliver the welcome address. Over to you, sir.
Thank you, CA Ankur. Am I audible?
Yes, you're audible, sir.
Okay, so I think you can start. Just a
Sure.
second.
So a great evening.
Okay, so thank you, Ankur. I think for people who don't know, Ankur is one of our new and young members of the chapter. So I'm really, first of all, let me start by thanking Ankur for taking him the MC role. So this is part of the inclusiveness efforts that we have been trying to do to have our non-ExCom members to take up roles at our events. So thank you, Ankur, for that. Respected speaker of the day, Mr. Anupam Rungta, dear members of BCICI, friends from the overseas chapters and invited guests, good afternoon to all of you. Let me first start, as we've been doing in the previous events, by reiterating our support, the support of BCICI for the vaccination drive that is being conducted by the Bahrain government. I congratulate all the members who have already done their vaccination, and for the others who haven't, we strongly encourage you to do so for yourself, your spouse, and eligible children now that the government is providing. And I also request everyone to have in your thoughts and prayers all those who've been affected by COVID in Bahrain and in India and the world over as well. So just to highlight some of the chapter activities that we have been doing, some of the ongoing activities and some of the upcoming activities. So we have a Lean Six Sigma Green Belt training ongoing. So this started at the end of last month. So this is still ongoing. We are celebrating this month. The theme for the month, it will be yoga in every home. So this is a theme that we are celebrating for the month of June. And as part of that, a number of activities are planned, and these are being rolled out. A number of our members are already preparing for what we call as a 108 Surya Namaskar challenge under the guidance of our immediate past chairperson, CA Mahesh. So this is ongoing, like every alternate day, early in the morning. We will also conduct two events under the patronage of the Indian Embassy. The first one is a special event for school children, which will be happening next Friday. So BCICI will arrange a yoga for concentration session by our Joint Secretary, CA Ria Bansali, and followed by a quiz about yoga by Mrs. Gayatri Vishwanath, the wife of CA Nath Venkatachalam. The second event will be the celebration on the 7th International Yoga Day on the 25th, where we will have the Indian ambassador as the chief guest. And of course, the Surya Namaskar challenge will also happen on the same day. So the people who undertake that will also be felicitated during this event. Of course, as you remember, last month we had rolled out the nomination process for the new committee. So we will hold the election meeting on the 24th of June for the election of the next executive committee under the leadership of CA Santosh. We will also have a special collaborative event with BIBF on the 26th of June. Besides that, we have rolled out a skit competition, which I hope you must have seen, where I hope members do participate in. This is part of the well-being efforts that we do. People have fun with families. So I hope people take up this opportunity as well. We have shared also details of two ICAI certification courses, which is specifically targeted at ICAI members in the Middle East. One is on derivatives, which will start on the 18th of June, and the other one is on Forex and Treasury Management, which will be starting on the 19th of June. So I hope members will take benefit of these sessions, which are conveniently scheduled for Fridays and Saturdays. And of course, there'll be some other events relating to fitness as well as learning, which we will be announcing in the due course. And also, in July, it does look like, again, unfortunately, that many of us and families may not be traveling to India. So we will still keep the activities going, and which will also include the CA Day celebration As you know, 1st of July is the CA day, and we'll have some events around that particular date, as well as you can also mark the date for the family day, the annual family day. Again, unfortunately, we may have to do it online this year as well, but the family day is being planned for 16th of July. Okay, so if you can note down, it's 16th of July. So please keep your dates free for that date. And coming to today's event, I'm very happy to see such a very good turnout for this event. So this is a very relevant topic for all our members. So we are very fortunate to have Mr. Anupam Rungta to handle today's session. So he's an experienced investment strategist and an established speaker on topics of excellence in mutual fund as well as in stock market. So I'm sure you will enjoy today's session, and he'll be making some announcements relating to a mutual fund excellence workshop that he conducts, and he is probably going to give a special offer for all the attendees today, I guess. So I really thank him and look forward to your session, Mr. Anupam. I also want to express my gratitude to our senior member, C. Akhil Mishra, who helped in connecting with Mr. Anupam as well. And so nothing further from my side. So I just wish all of you a wonderful session. And with that, I thank you for your listening, and back to you, CA Ankur.
Thank you so much, CA Ajay. So as CA Ajay has give a brief introduction about our speaker, sir. Let me introduce him. So we are quite honored to have our speaker, Mr. Anupam Rungta, today. He is a SEBI registered research analyst, trainer and investor, CFP, with more than 14 years of experience in varied fields like equity markets, mutual funds, startup consulting, real estate, insurance, business research, and advisory. He grew up seeing his father reading annual reports, journals, and business newspapers. His father started investing way back in 1978, and this is where Mr. Anupam Rungta's investment journey started. So he started his investment journey from his very first paycheck in 2006. So he will give us a brief introduction of the do's and don'ts in mutual funds that is very important for all of us while we make our investment decision. So let's learn more from our speaker, sir, about the mistakes that we should avoid while we invest in mutual funds. Over to you, sir.
Thank you so much, Ankur. Am I loud and clear?
Yes, sir.
Yeah, perfect. Thank you, Ankur. Thank you, Ajay, and the ICAI chapter of Bahrain, and a special thanks to Akhil Mishra for connecting me to you people. I hope the next 1.5 hours are fruitful and you don't regret calling me. So anyway, let me share my screen. Can you see the screen, all of you? A couple of yes will do. Ankur, can you see the screen?
Yes,
sir.
Yeah.
Perfect. So without further investing more time, Ankur has already given my introduction. You can always go to my website later on, anupamrungta.com, after the session, and you can read more about the kind of work we are doing. So let me start with the session right away. So this is what Warren Buffett says. He says, I really believe it's better to learn from other people's mistakes as much as possible. And we all, I believe, agree to this. There are two ways to learn things. One is you experience everything yourself. The second is you do experience some things yourself, but you learn from others' experience also, so that you can save your time, money, and energy, right? So a lot of things, there are a lot of mistakes which people make in mutual funds every now and then. I mean, we have been making those mistakes for ages. And the new investors, when they get into this industry, they make the same mistakes again. And I also have observed in my last 14 years of journey, I believe as a society, we have failed to pass on the learnings of investments to the next generation. Maybe because it could be, I mean, the reason could be from both the sides. The person who is sharing the knowledge is not convincing enough, and maybe the person who is listening to that that insights is not really ready to listen. Everyone feels that I want to experience it myself. Maybe they made some mistake, maybe they don't know how to do it. I know how to do it, right? But the ideal way will be you learn as much as you can from the others' mistakes, so that you don't make at least those mistakes in your investing journey, right? If you have to make mistakes, at least make the new ones. What's the point? What's the pride in making the same mistakes again and again? Yeah. So 3 secrets which we will discover in this next 1.5 hour session. Number 1, you can earn at least rupees 1 crore more by gaining expertise in mutual funds. I'll not talk much about it right now. I'll just take you there in the session and then you'll get to know. The second one, looking at past performance of a scheme beyond 10 years is meaningless. Now, what does it mean? You might have heard of schemes which were launched, let's say 20 years back or 22 years back or 25 years back, and their returns for last 20-25 years compounded annually on an average is 18%, 19%, 20%, which is exceptionally good, which is like a superstar scheme. But what I am telling you is it is meaningless to look at any scheme's performance beyond 10 years. And I'll tell you why in this program, in this session. And the last secret which you will discover, which is also quite unfortunate, is that very few fund managers invest their own money in the funds they manage. Now, just take an example of, let's say, a cafeteria. You are going to a cafeteria very regularly, and one fine day you get to know that the owner of the cafeteria never eats in that cafeteria. So that will definitely make you a little uncomfortable. That what's the point? What's the issue? Maybe there's some hygiene issue in the kitchen, or maybe something else because of which he is not eating in his own cafeteria. Similarly, we are giving our money to the fund manager, and if that fund manager is not investing his own savings into that, in his own investments into that particular scheme, that will make me a little uncomfortable as an investor, right? Thankfully, this is changing because the SEBI has come up with some new regulations in the month of April, hardly a couple of months back. I'll talk about that, but still we have a long way to go. Yeah. A couple of disclaimers. Number 1, this session is only for education purpose. We will talk about schemes and sectors, and we may shortlist something, we may talk good about something, bad about something, but don't take it as an advice to buy, sell, and hold. You will definitely be able to implement something in your portfolio after this session, but having said that, don't take the name of the scheme as any kind of an advice. Please don't do that. Yeah. It doesn't work in the long run. It's not just about getting into the right scheme. It's also about monitoring and exiting at the right time. So even if you know which scheme to enter into, that's just half knowledge. And sometimes half knowledge is more dangerous than no knowledge. Yeah. So be very, very clear about that. And this session is for 1.5 hours, including Q&A, including everything I need to share from my side. If there are more questions, definitely, I am happy to answer them and take it beyond 1.5 hours, but I'll make sure we get over by in 1.5 hours. And yeah, how it will work, I'll talk about a topic, followed by you can ask me some questions in the chat box. I'll answer some of them, if not all of them. Given the audience and the number of people attending this session, I might not be able to take all the questions. I'll take up a few questions and I'll move to the next topic and so on. In the end, in the Q&A, I'll again take up your questions if I miss any. Yeah. Sounds good? Perfect. So the first one, past performance. Just a second, guys. Yeah. So as I told you in one of the secrets of this in the initial slides, that you're not supposed to look at the returns since inception for funds launched beyond 10 years. Since inception means since when they were launched. So if a fund was launched beyond more than 10 years back, it's not important for me to look at that return. That's not important. Now, before I take you to this example, let's look at this chart. Let's say a scheme's NAV, the price of the scheme, mutual fund scheme, was 100 rupees in year 2000. And by the end of 2020, December, it was 2,739. This is 18% compounded annual returns, which is excellent, which is like a super returns, no doubt about that. Now let's assume everything else is taken care of. You surely don't have to look at only the past performance of a scheme to finalize it, but let's say we have taken care of everything else, and you just look at this one more parameter. Answer me in the chat box with a yes or no. Will you invest in this scheme looking at this? A few yes or no in the chat box. Will you invest in this scheme if you look at this data point? There's no right answer. It's up to your judgment. But you're looking at a scheme. Everything else is taken care of. That's the assumption. I'm sure the answer could be that we will look at other things. I'm saying everything else has been taken care of. The only thing you're now looking at, the last parameter, is the performance. Yeah. So a lot of people saying yes, and a lot of people, quite a few people saying no as well. Okay. Now let me give you one more data point, and then I'll ask the same question. This scheme gave a return of 27% compounded annually, 27% CAGR in the first 10 years, and 9.7% in the latest recent 10 years. Now, those who said yes, only they should answer. Do you think now you will invest in the scheme? Yes or no? Now the answer becomes no to quite a few. Yeah. So let me tell you, take you through this one example. DSP Top 100 Equity Fund. Let me show you some figures of this particular scheme. We are going to this website called advisorcoach.com. Just a minute. Yeah. So I'm highlighting on the left hand side. Look at the launch date of the scheme. March 2003. So more than 18 years back. Yeah. Pretty long time. On the right hand side, I'm highlighting again CAGR. Look at this, more than 19% compounded annual returns of last 18 years. This is amazing. This is exceptional performance, no doubt about that, right? But let's go down. Now look at this. Last 10-year returns is 10.69%. Yeah. So what worked for the scheme in those first 10 years gave them exceptional returns. But after that, maybe the fund managers changed, maybe their approach did not work, and now they are not able to generate the kind of returns which they generated initially. So when you listen to other people also who claim the same thing, that don't just look at the past performance of a scheme to invest. So this is also one of the reasons. Past performance is not enough. I'm not saying you should reject the scheme also based on this. The only thing I'm saying is, don't get impressed by a scheme which is showing returns of last 15, 20 years, 25 years compounded annually. I may still invest in this scheme for other reasons, because maybe everything else is fitting in. I don't know. I'm not talking about that. All I'm saying is, don't get impressed by a scheme which is showing this kind of a performance for 12, 13, 14, 15, 20 years. It's irrelevant. Right? And I told you the reasons. Number one, it could be that fund manager initially was someone else. Now it is someone else. The earlier fund manager could perform. The new fund manager is not able to perform. There are so many SEBI new regulations which have come up especially in last 5 to 7 years. Maybe because of that, the fund performance has gone down, because it has become stricter for the mutual fund companies, right? I mean, the business dynamics are changing. The way businesses work in the country, the way stocks perform based on those businesses, that is changing. So whatever approach they had initially, maybe that worked. Now it is not working. Right? So don't get impressed by a scheme which is showing this kind of a performance for a very long time. Now, what should you look at? Ideally, 5 years is a very good time frame to look at. Why? Neither it is too long. It's not like 8, 10, 15, 12 years. Neither it is too short, like 1 year, 1.5 or 2 or 3 years. So 5 years is a good enough time to tell me the consistency of the fund manager. Again, just looking at 5-year return is not enough to shortlist a mutual fund scheme. But I am saying, when you're looking at the return aspect of the mutual fund, then 5 years is a good time frame to look at. Right? Now, why not 1 and 3? Why? What's wrong in looking at 1 and 3 year performance? Let's again go to another link, and I'll tell you some more data point which will help you look at this. So this is equity small cap category. In this, I have taken equity small cap category, last 1 year return. Right? Look at this. This is ranked as per 1 year returns. So quant small cap scheme has given a return of 190% compounded annually for last 1 year. That is, let's say you invested 10 lakh rupees in this scheme 1 year back, your money would be around 29 lakhs today. 10 lakh would have become 29 lakhs today in last 1 year in this particular scheme, right? And because of this, the rank of the scheme is 1 out of 23. Number 1 rank in all the schemes in this category, that is small cap category, right? Even the last 3-year rank is 1 out of 15. So in last 3 years, the number of schemes which were existing for last 3 years is only 15. So it is again number 1. But if you look at last 5-year rank, it is 5 out of 14, which is not too great. Now I prefer to look at top 3-4 schemes in a particular category. Not even 5th is not bad. But the point is, the scheme's performance has suddenly showing down for the last 5 years. Why? Because last 1 year, maybe the fund manager got lucky. Because of that 1 year performance, even the 3-year performance is looking biased. Whereas 5-year performance will tell me exactly whether the fund manager has been able to do this consistently or not. Now, I'm not saying this scheme will not give good returns in the future. I don't know. That's not the point. The idea is, I'm looking at a scheme which is more consistent rather than being lucky. That's all. Yeah. And one more thing. you can never have your best portfolio ever. You cannot have like the best 5 schemes in the portfolio which will give the best returns in the next 5 years. Never. That's not possible. So don't regret that, what if I miss this opportunity? What if I miss that opportunity? You will always miss out some or the other opportunity. Do you think Rakesh Jhunjhunwala, Vijay Kedia, Warren Buffett, Philip Fisher, Peter Lynch, all of them have the best stocks in their portfolio? Go to Google, find out the stocks in the portfolio of Rakesh Jhunjhunwala. You yourself can Google and find out 100 more stocks which are giving better returns than the best stock in Mr. Jhunjhunwala's portfolio. So he has missed more than 100 opportunities, and he will keep on missing them. Still, he is one of the richest. So what I'm trying to say here is, don't regret missing out on opportunities, because you will never have the best portfolio. The idea is to have the optimum portfolio and to be able to fulfill your financial goals. Yeah. Now, so that the reason for not looking at 1 and 3 year performance is last 1 year returns can make it look biased. Yeah. Now, any questions in this particular topic before I move forward? Considering the current situation since March 2020, stock market has more than doubled. So all the schemes are overperforming currently. How do we start identifying schemes to avoid losses in case stock market goes down? So Josefa, first of all, when the stock market goes down, for example, someone started investing in, let's say, March, April 2019, and the market went down in March and April 2020, right? So no matter what, what scheme you're investing in, if the market is going down the way it went in 2020 or any other period, all your schemes, all your stocks are bound to go down, no matter how fundamentally strong they are. It's a good question. The point is, when you're investing in equity market, your investment horizon should be minimum 5 years. If you're investing for 1, 2, 3, or 4 years, you're not investing, you're speculating and gambling. And that's my view, of course, but I'm just telling you from experience. If you're investing any money in the equity market for less than 5 years, you're speculating and gambling, you're not investing. Yeah. And for that matter, someone who started investing in March, April 2015, even in the bottommost point in March 2020, the portfolio returns were more than 12% CAGR. I'm sharing from my own experience and the experience of a lot of my investors. So when you're investing for long term, even the sharp fall in the market will not impact your portfolio in a huge manner in the percentage terms. Of course, the returns were much higher before March 2020. Like for example, in Feb 2020, that returns came down, but it still was way above the inflation what you should beat. So you will be able to fulfill your financial goals no matter how down the market goes when you're investing for long term. NFOs, Sairam, I don't recommend NFOs, again for the reason that I have so many options available in the market for which I can look at the track record. I don't have any incentive to go into NFO. And if you're getting attracted to any NFO, let me tell you, the marketing done by the mutual fund company is very good. Please understand, they have to sell the scheme to you. So they will say things which make you invest in that NFO. Now, again, I'm not saying NFO will not give you returns. The idea is, why do you want to put your hard-earned money into something which is on chance? Yeah, I have so many options available in the open market. Why would I go for an NFO? Yeah. SIP or NFO, which is better from return perspective? It's not SIP or NFO. You are asking, I think, SIP or lump sum. So SIP is like when you're investing regularly on a monthly basis. Lump sum is when you put money together. There's no right answer which is better, because both can give good returns or bad returns. Again, when you're investing for long term and you're investing in a disciplined way, SIP will always work good in terms of discipline, not in terms of returns, right? So SIP is something I prefer from practical point of view. Okay, last question I take, and I go to the next topic. Considering the current market levels right now, is it right time to get into the large cap or index funds right now? Uday, very good question. It's $1 million question everyone is asking. So let me tell you something. You and I or anyone can never time the market. That market is at high level, should we exit now, and then when the market goes down, I'll enter again. If that was possible, all these successful people would have done that already. Why aren't they doing it, or why have they not done it ever in the past? Number one. Number two, I know so many of my own known friends in my circle, and even my investors who exited the stock market in July, August 2020, and they were logically right. Why did they exit? They said this market is almost at So pre-COVID levels, the Sensex reached 39,000 in the month of July itself, from the low of March, 26,000. And the economic activity is hardly there. I mean, the lockdown has just started opening and there's no economic activity. Why is the market so up? It's crazy. It doesn't make sense. So let me exit right now. When the market goes down in next 2-3 months, I'll enter again at a lower price. And we are sitting in June 2021. We know where the market has gone. Right. So don't time. I'm not saying it will keep on going like this or not. That's not the point. When you're investing for long term, 5 years plus, you're bound to make money, even if you start at the peak of the market. And 2007 is the best example. People who started investing I started investing my own money into stock market in 2006-7 when I started making money. So my portfolio was the best example. In 2007 is when I invested in a good amount of money. I started investing 2006 mid second half, and 2007 entire year I was investing. 2008 January the market started going down. Till 2010 my portfolio was in loss. But I was investing every month on a regular basis. By 2012 end, when the 5 years were over, my portfolio was more than 15% CAGR. So even if you start at the peak of a market, but if you're investing for long-term goals, you're bound to make money. The point is that 5 year doesn't sound too long right now, but when you're investing in the market, 5 years looks like 5 decades. That's the problem. Yeah. Let me go to the next topic. I'll take up questions later on. Why avoid these categories? Now, there are various categories in mutual funds: large cap fund, mid cap fund, small cap funds, large and mid combined, sectoral funds, and all those. There are some categories of mutual funds which you can avoid investing into. And I'll give you the reasons behind that. Right? Number one, sectoral funds. Now, in any sectoral fund, let's say banking fund or pharma fund or technical tech fund, minimum 80% of the investment of that mutual fund scheme has to go in that particular sector. That's as per the SEBI mandate. Right? Now, I am saying don't invest in sectoral funds. Let me tell you the reasons behind that. Number one, first question you need to ask yourself is, do you know this sector well? Let's say you are working in an IT company and you're an engineer, you're a techie guy, and you know this industry very well. For last 15-20 years you are working, and you say, I know it in and out, I know it very well, right? Then my next question will be, if you really know this sector so well, if you really know what is happening there, you can judge the company and all. Why do you want to invest in a mutual fund scheme which has got 22 stocks of that sector? Why don't you pick up 2 or 3 stocks of that sector and invest and make more money? Think about it. If you say that you know the sector very well, then why don't you invest in a couple of stocks rather than investing in 20 stocks? So no matter how good the sector is about to do, all the stocks in the sector will not do good. There's something called competition, right? Some stocks will do good, some will not do good, some will do average. Your returns will be average in a good sector also. So what's the point of investing in a mutual fund scheme of a particular sector when they're investing in 15, 20, 22 stocks of that particular sector? It doesn't make sense. Right? That's number one point. Number two, just understand one simple aspect of mutual funds. Let's say you are investing in a mid-cap scheme, no sectoral scheme, normal mid-cap scheme. And that scheme has got 60 stocks, for example. And fund manager is investing in various sectors. He's investing in auto also, pharma also, banking, infrastructure, tech, all the sectors, he's diversified the money in a certain manner. Now, at any point in time, if the fund manager's research says that this, let's say, auto sector is not supposed to do well in next few years, so what he can do, he can simply exit those 2-3 stocks in which he invested in that auto sector and invest that money into other sectors and other stocks. Simple, right? But if you are investing in a pharma sector scheme or a banking sector scheme or an auto sector scheme, do you think the fund manager will, or the mutual fund company will ever come in public and say that this sector is not supposed to do well, we don't expect this sector to do well, so we are exiting, we are closing this scheme? They will never do that, because it's a business they are doing. They cannot tell them, they will always sound positive about that sector. They'll say, no, this sector is bound to do well in long term, please invest, keep on investing, keep on investing, keep on investing. They will never ask you to exit. Why? Because why would they do that? They are in business. So you are bounding your fund manager with a particular sector ki isi sector mein invest karo. Why? Please understand from their point of view. They will never come and tell you. So as I said, in the other normal schemes where every sector is involved, fund manager can very flexibly take that call that exit these 2-3 stocks or exit this sector, enter some other sector. But in this case, they cannot. right? Next, do not look at sector, be it stocks or mutual funds. So this question which investors ask, which sector is expected to do good, is the most irrelevant question ever. My request to all of you is stop asking this question, which sector is supposed to do well? And let me tell you why. We all know in last 20 years, telecom has done brilliantly. I mean, look at the number of mobile phones we had 20 years back and look at the number of mobile phones we have today, right? It came as a luxury and it has become a necessity. Right? This is the best thing which can happen to a sector, right? Look at the stocks performance in this sector in last 20 years. Companies have gone bankrupt. They have gone out of India. Those who came from outside India and established their business here, they've been mergers and acquisitions, and even now companies are going bankrupt. So even though the sector did so well, why did companies lose money? So there is no such concept that a sector is doing well. It means there has to be some stocks in the sector which will do well. No, not necessarily. Let me give you another example. I remember in 90s when I was in my school time and used to go out for some vacation, most of the time, whichever city or town we were going to, there was some relative or friend there of relative of ours or some friend of my father, and we used to stay there at their place. Now, I mean, pre-COVID, when we go out for any vacation, no matter who we have in that city, we prefer to stay in a 4-star or a 5-star hotel, right? Look at the performance of hospitality stocks last 20 years. Why haven't they performed? Let me tell you the reason behind why. Something called competition. Look at your country, look at your, whichever city you belong in India. There is some or the other business which is famous for every city or town or region, right? That this city is known for this business, this city is known for this business. Whichever that business is, there are many players in that business because everyone wants to make money. And because of that, the competition is there. For example, tech, IT sector. Infosys is getting competition not only from Wipro and TCS and Tech Mahindra. They're getting competition even from the guy who's sitting in his room with a laptop and doing some software work. Infosys is getting competition even from the very small IT firm in your city, which has only 10 employees. So competition is not only from listed players. Competition is also from non-listed players, small players. So any sector which is bound to do good in next 5, 10, 20 years, there will be so many new players which will enter that sector. So having said that, there are cases when the sector did well and the stocks did well. There are also many cases when the sector did well, but none of the stocks did well. It's always better to look at the stock first and then the sector. Go the other way around, bottom-up approach. Having said that, there can be sectors which are not doing well, but there can be 1 or 2 good stocks which will do well even in that bad sector. It's like a lotus flower in that, in the pond. So stop asking this question. Last one on this, and then I'll move to the next sector, next tech category. Many experts, you might say, but so many experts are still talking about pharma and tech, doing well in the next few years, and it is bound to do well. Why not? I mean, it's obvious, it's common sense. See, the point is, for last 10, 20, 30, 40 years, some or the other expert has been talking about some or the other sector every time. Yeah, every year, every expert is giving his or her opinion that this sector is bound to do well in the next few years, right? Were they all right? Number one. Number two, if they were all right, there would have been no poverty in India or in the world, because everyone would just follow the experts, invest their money and make money, and it's done. You're done. You're sorted. There will be no poverty, right? So the second point is this. Third point, even if you believe in a particular expert, how much money did you invest? Let's say last year someone said pharma will do very well, tech will do very well, or whatever, FMCG will do very well. You had a portfolio of, let's say, 20 lakh rupees, and you invested 50,000 rupees in pharma. What difference did it make? 50,000 became 1 lakh, 1.5 lakhs. That's fine, not bad. You made, but did it make a difference to your financial life? Did it make a difference to your financial freedom? No. So even if you know the answer that something is going to happen, what is your conviction level? That is defined by how much money you're investing in that as a percentage of your portfolio. It's very easy to comment that what will happen in future, but how many can really invest a chunk of money in that? with that conviction. Yeah. Next one, dividend yield funds. It's a funny category, I would say. What is dividend yield? Dividend funds, basically, they invest in those stocks which give high dividends, right? So dividend yield is how much yield, how much dividend you are getting from a stock on a percentage basis. So let's go to this sector. Okay, before that, let me give you an example of the sectoral funds here. I'll take you to one of the sectoral funds and try to show you something. As you can see the name, SBI Healthcare Opportunities Fund. So this scheme is going to invest in pharma or healthcare stocks. Let's go down. Look at this number of stocks, 23. 23 stocks are there in one particular sector. Look at the name of the companies. Go down. Look at this. Dr. Reddy's Lab, Sun Pharma, Aurobindo Pharma, Cipla, Lupin, Divi's Lab, Alken Laboratories, Narayan Hrudayalaya, Cadila, Max, Gland Pharma, Solara, Apollo. Every company is there. Do you think every company will do well? No. This will give you, I mean, this may give you more than, maybe some other sector, but it's not, there's no, as I said in the first point, if you know the sector well, why don't you invest in a couple of companies and make more money? Now you might say, I don't know any sector well. I would say that's a good news. If you don't know any sector well, that's a good news. Why? Because you are investing in mutual funds. You are hiring a fund manager to do this job. You are not supposed to check which sector will do well, which sector will not do well, which stock will do well, which stock will not do well. That's not your job. That's fund manager's job. So if you think that you don't know any sector that well, it's a good news. You will not get influenced by these different sectoral funds. Yeah, dividend yield funds. I'll take up questions after this slide is over. A few questions I'll take up. Look at this. Look at the number of schemes, first of all. Number of schemes is only 8. So first of all, I don't have enough peer comparison. Only 8 schemes are there, right? Next, look at the returns. If I arrange them by returns, 17%, last 5-year return I'm looking at, 17%, 16%, 14, 13, 11. This is way below what a mid cap or a small cap or a large cap index fund has given. What's the point? This is just a fancy scheme, dividend yield fund. Just a fancy name. Let's look at one more category, value funds. What is value funds? You must have heard of value investing. So basically, you're investing in those stocks which are undervalued, so that you can make more money in the long run, right? So that's called a value fund or value investing. So let's go to they are supposed to give more returns. A value fund or a value scheme is supposed to give higher returns than any other generic scheme, right? So let's go and check the returns. Again, 5 years I arrange by highest lowest, 16%, 16%, 16, 14, 14. Now, just to give you a comparison of whether this is a good or not, let's go to any one category. Let's go to equity mid cap summit. Look at this. 19.54, 19.35, 18.18, 18, 17, 17, and that was starting from 16 and then it went to 14. Now, even a value fund is not able to beat a small, simple mid-cap scheme. Whereas, as per the names suggest, it should be value investing and it should give you higher returns, right? But why is it not giving returns? Because you have bounded fund manager to invest only in low PE stocks or low valuation stocks. It is not that every time low PE will work or every time high PE will not work. It's not about that. Don't bound the fund manager. If you're bounding the fund manager, you are hitting yourself with a rod. वो एक कहावत ना कुल्हाड़ी पैर पे मार ली, is that don't bound the fund manager, right? Contra fund, contra is from contradictory word. So investing in those stocks which are contradictory to other market opinion. For example, ITC is not doing well for some time, so fund manager might say that I want to invest in ITC because I believe in this company for the long run, right? So I'm contradicting what others are doing. Others are not investing in ITC, most of them, or they don't believe in this company, they're not making money, but I will invest in ITC. So that's called contradictory. Same story with contradictory funds. And the most funny and the ridiculous category is called thematic funds. Let me show you what it is. I'm telling you what not to do, what mistakes you should avoid. Look at the various options within thematic category. Thematic consumption. So they will invest only in consumption-driven stocks. For example, HUL, Britannia, Nestle, Pidilite. All these are consumer-driven stocks. Thematic energy, only energy companies. Thematic international, only international companies. Thematic MNC, all the companies which are MNCs, only in those companies. Thematic PSU, only government companies. Now, this is a joke. I mean, it's my hard-earned money. It's not some fancy dress competition where I will do some theme-based investment. Why will I invest in such schemes? Why are you bounding the fund manager? And you might ask, why do they have all these schemes? Please understand from the point of view of a mutual fund company, they are in a business of selling mutual fund schemes. They want to give you as many options as possible so that you choose at least one or two out of them. It's like a showroom. You go to a showroom, there are thousands of show pieces. Do you buy all of them? No, you buy what you need. Right? So there are thousands, hundreds of different mutual fund categories and mutual fund options there. Do you buy everything or do you get attracted by everything? No. You look at what is good for you. Right? Makes sense?
Okay.
What is ETF and index fund? So ETF is just a stock version of index fund. And exchange traded fund. So when you list the index fund on a stock market, it's called ETF. What is the best strategy to invest lump sum around this time? Let's say around 50 lakhs. So if you're investing lump sum, again, there is no right answer. You can invest at once, or you can spread that money over a period of 6 to 12 months, depending on your comfort level. If you ask me what will give you higher returns, there is no right answer. Look at your comfort level. Are you comfortable investing in lump sum? Go ahead. Are you comfortable in investing this money over a period of 6 to 12 months? Go ahead. Yeah, PMS is different from mutual fund. So I'll request if you can ask me questions relevant only to this topic we are discussing so that we can focus on one thing and I can, you can strengthen your learning further. If you have other questions apart from what we are discussing, I can answer that in the Q&A section in the end. Difference between thematic and sectoral funds. Good question. So sectoral fund means sector oriented, pharma sector, banking sector, all this. Thematic is theme, PSU theme. So they will invest in all the PSU government companies. It could be a banking company also, SBI, it could be NTPC also, it could be SAIL also. So all the PSU companies. MNCs. So MNC can be a multinational company, it can be in a banking sector also, in a pharma company sector also, in a infrastructure also. Right? So thematic and sectoral, that's the difference. So thematic is more about a particular theme rather than a sector. What about pension fund? So pension fund and all these are just, again, names given to the schemes. Look at what are they doing at the background. Where are they investing? Large cap, mid cap, small cap, whatever, where are they investing? That's more important. And pension fund is mostly from the point of view of insurance companies. They come up with pension plans and all that. I think they have in mutual fund also, but look at where are they investing? That's more important. Okay, one last question I'll take for this question. Sairam is asking, there are particular sectors which are market leaders during specific periods. Example, pharma post-COVID, IT sector post-IT boom, etc. So is it wrong to invest there for 3 to 4 years until that sector is good? Again, since we can't decide which company is good, we are going with pharma fund as a whole. Okay, good question, Sairam. So the point is, no one is going to tell you that, ab is sector ka time khatam ho gaya. That, invest for 2 years, 3 years and then exit. No one is going to tell you. Number one, it's easy to say in the retrospect, wish I had invested in IT sector or pharma sector for this period, I would have made this much of money. That's easy to say in the retrospect. Tell me which expert can you believe today who is saying invest in pharma sector or IT sector, and how long can you keep on investing as per his or her opinion? And what is the conviction level you have? If you have the conviction level, please go ahead. There's nothing wrong in that. All I'm saying is you should know the challenges with that. You should know the why behind what you're doing and why behind what you're not doing. If you are confident that you want to do this, go ahead. But the point is, it's easy to say what happened in the past, but very tough to take decisions in the future. Okay, next topic, regular versus direct. Now, a lot of you might have heard of this concept. You might know what direct plans are, because a lot of awareness has been spread in last few years with respect to direct plans by SEBI and by the mutual fund companies. But having said that, not many people know about the impact it may have. So I'll show you some figures also today. Having said that, I am not in favor of direct plan or against regular plan or vice versa. I will tell you pros and cons of both. And then you as an investor, depending on your requirement, you have to see which suits you more, right? So there's no right answer. It's more about what works for you. So you buy a regular plan when you're dealing with an advisor or a broker or an agent or a distributor. So MFD is what? Mutual fund distributor. So if you have any agent who is serving you, 99% chance is there that person has a license called MFD, mutual fund distributor license, right? Now, even your bank and brokerage house is a distributor. So some people, let's say you have your banking, banking with SDFC Bank or Kotak Bank or ICICI Bank or whichever bank it is. You might have a relationship manager who is guiding you on mutual fund schemes as well. He's managing your portfolio. Maybe you have a brokerage house, you have a demat account with ICICI Securities or Kotak Securities or wherever. And you have a relationship manager there who is helping you create your mutual fund portfolio. Even they are a distributor. They have a license called mutual fund distributor and they're making commissions from the mutual fund company. Now, what is TER? TER is a short form for total expense ratio or expense ratio. It is nothing but the annualized charges which the mutual fund company is charging you. For example, in a particular mutual fund scheme, equity scheme I'm talking about, pure equity scheme, not hybrid, balanced or debt scheme, pure equity scheme, annualized charges is anywhere between 1.8 to 2.5% per annum, right? Out of which 1% goes as a commission to the intermediary, which could be an agent or distributor, advisor, whoever it is, right? So 1% commission goes to them, because if you notice, whoever is managing your portfolio, he's not charging you anything. He's not asking you to collect any check in his company's name, right? Because he's getting commission from the mutual fund company. So he's making his money. You are, getting the service you need. So it's like a win-win situation, right? Now, there is something called direct plans for every mutual fund scheme. So you're choosing, let's say, ABC mutual fund scheme. It has got both the options, regular plan or direct plan. So you can buy a direct plan either directly from the website, or you can buy it through a various. I think someone's mic is on. If you can just mute your mic, everyone. Yeah. So direct plans can be bought directly from fund house and various platforms also. I'll talk about the platforms in a few minutes. Now, example, before I go further, let's go with this example to explain you further. There's a scheme called Motilal Oswal Mid Cap Fund. We go on Value Research website. This is called regular plan. Look at this. The option selected is regular plan on the left hand side. Now let me go down and look at the expense ratio for the scheme. Look at this. I'm highlighting on the right hand side. Expense ratio is 2.08%. So every year 2.08% is deducted from your investment, and that's how the mutual fund company is making its money. Because even the mutual fund company is not charging you anything directly. They're not asking you, you're investing in SDFC mutual fund, cut a check every year and give me the fees. No, they're automatically deducting the fees at their end, right? Now let's go up and I'll change this to same scheme, direct plan. Okay, just a second. Why is it asking this? Not sure why this is asking. Let me see if this works. Let me open another link. Now I'm looking at direct plan of this particular scheme, right? Let's go down. Look at this. Right hand side, I'm highlighting again. Expense ratio is 0.72%. So instead of 2.08%, it is 0.72%, about 1.36% difference, right? Which is quite significant. On an average, the difference between a regular plan charges and a direct plan charges is 1%. This is kind of an exception, which is 1.36% difference, right? Now, to understand this further, some people get confused on what is the difference between regular plan and direct plan in terms of investing. So please understand, there is no difference in the scheme. The scheme is same, the stocks are same, the fund manager is same. Just that you have someone to advise you in the between. For example, you are selling a property, or let's say you are buying a property, right? You talk to a few brokers who start looking for the property for which you need. They make you visit the properties. They do all the hard work which is required on the ground. And let's say you finalize some property through a broker. Now you're going to pay that 1% brokerage to them. Whatever the brokerage, let's say it is 1%, you pay that 1% brokerage. Now let's say there was no mediator in between, no broker in between, and you were lucky to find some property which you need directly from some contact, right? In that case, you save that 1%. Simple, right? But the property is same. It's the same property, same location, same dimension, same price, same seller. Everything is same. There is no difference, right? Similarly, you come to mutual funds. Whether you buy the direct plan of a particular scheme or a regular plan of a particular scheme is same. Just that in a regular plan, there is someone called a mediator or an advisor in between who is helping you invest in mutual funds, who is doing all the back office work and advising you which are the good mutual fund schemes. And for that, he is charging you 1% indirectly through the company, through the mutual fund company, right? Rest, everything is same. Yeah. Now, to look at it mathematically, look at this example. Let's say you start investing 25,000 rupees per month in a regular plan and also in a direct plan of the same scheme, right? And you invest for 30 years continuously. Now, the assumption is you're not increasing your investment, which is a wrong assumption to make, because you will naturally increase your investments as you move forward and you earn more and you save more. But for the example's sake, we are keeping it constant, right? The returns will be difference of about 1%, because you're paying more in regular plan, more charges you're paying in regular plan by, let's say, by 1%. So your returns will also be less than 1%, less by 1%. So in a regular plan of a same scheme, you will earn 12%, let's say, and the direct plan of the same scheme, you will make 13% annually. So annually, this expense ratio is deducted. So annually, you will save 1%, right? Look at the final figure. So difference of 1.7 CR. This is assuming you're not increasing your investments. Yeah, this is assuming your lump sum investment is right now zero. If you're investing, let's say you already have a portfolio of, let's say, 2 crores. So 1% of 2 crores is 2 lakh rupees. So every year you're cutting a check of 2 lakhs and giving to your advisor indirectly. Whatever your portfolio is and you're investing in regular plan, just take 1% of that. That is the fees you're paying to the advisor every year. Nothing wrong in that. Don't get influenced by this figure and move to direct plan. Let me tell you more about it. Let's go forward. Do not invest in direct plan just for the sake of saving 1%. Please don't make this mistake. I know so many of my own friends who have made this mistake. Why is this a mistake? People move to direct plans for saving that 1%, but they stop monitoring their portfolio. And I know my friends whose returns have gone down by 4 to 5% after they move to direct plan. Why? Because they have no one to guide them, and they're not investing enough time and energy and monitoring which is required to run that portfolio. To save that 1%, you have lost 3 or 4%. Don't just look at saving money. Also look at what are you getting in return. You should be sure that you will be able to devote time and energy to monitor the portfolio. If that is not the case, it's okay if they are making 1%. They are also generating returns for you. I mean, if they are. You might have heard of this saying, penny wise, pound foolish. Don't be one. Again, I'm not encouraging a regular plan or encouraging a direct plan. I'm telling you the pros and cons of both. You see what is suitable for you. So you should opt for a regular plan when you need advice on creating and monitoring the portfolio. So there are hundreds of mutual fund schemes in the market. Every scheme is not giving returns. In fact, most of the schemes are not giving returns. So it's an art to choose the right mutual fund scheme and make a complete holistic portfolio. So that is the job of the advisor or the agent. And second, the support in back office operation. What is back office operation? KYC of your investment every couple of years. KYC, re-KYC, bank mandate, increasing your SIP, reducing your SIP, starting a new SIP, doing lump sum investment, exiting something. All this is back-end operation. Look in having a portfolio, software to see your performance of the portfolio at one place. All this is back-end operation. It looks simple, but it does involve a lot of time, energy, effort, and money. So they do all this on your behalf, right? So you see what works for you. Maybe direct plan works for you, maybe regular plan works for you, but you should be sure what you're doing. Make sense? Okay. Isn't NAV of direct plan and regular plan different? Obviously, NAV is different. Why? Because the charges of regular plan are higher. So that's why the NAV is less. Because NAV is declared, by the way, expense ratio is deducted every year. So for example, 2% is the expense ratio, divided by 250 trading days. Per day, 0.008% is deducted, and then NAV is declared. So in case of regular plan, the deduction will be slightly higher every day. So the NAV of a direct plan will be higher than the NAV of a regular plan. So that is okay. I mean, we just saw that the result, the impact it will have in terms of the amount of money. What will be the interest of broker to advise in direct plan as his commission gets reduced? So not reduced, Chinmay, commission is zero in a direct plan. So in that case, they will charge you a fees. I will tell you more about the different kinds of advisors. The natural question is what options do we have? So we have quite a few options. I'll tell you more about that. What if we have 10% in regular plan and 90% in direct plan of the same scheme? Can we do it under same folio? Can you do it under same folio? I'm not sure. This is something you need to find out maybe from the AMC. But yes, you can do what you are trying to do. I'm getting what are you planning to do? Is there any tax benefit for investment in direct plan? No, there is no tax benefit. Everything else is same. Is there any tax benefit whether you buy a property through a broker or without a broker? No. Just look at the example of property deal. There is no difference except one difference, that you have an advisor or agent in between who is charging you 1%. Everything else, taxation, in terms of the performance, in terms of the growth, everything is same. Just because of that 1% extra charge, your 1% return will be less. Equity diversified is better or index fund is better? Sanjeev, this is a very broad question. I cannot answer you in one liner, because this is the question which is answered after looking at a lot of things. But I do believe in investing in index funds for large cap category. For the other categories, I would suggest investing in active schemes. Usually advisor come at the time of inception of an investment and then they disappear. What is your view? I'll tell you about this, Nirmal, about this point. There could be something called conflict of interest. Who are these advisors who come and then they disappear? I'll tell you about these advisors in a few minutes. PMS is better or mutual fund? There's no right answer. PMS is a different product. Mutual fund is a different product. Maybe you can invest both and then see what works for you. So not that every PMS will give returns, not that every mutual fund scheme will give returns. So it's about which PMS you're investing in. It's about which mutual funds portfolio, what kind of portfolio you're investing in. There's no one answer. Right? Now, how to choose your advisor? A lot of people are asking about advisors and all. So let's come to that. And let's see what mistakes you should avoid there. Right? So the most common form of license is called mutual fund distributor. Right? MFD. As I said, most of the time, if you have an advisor with you, most of the time that advisor will have this license called MFD, and they will make you invest in regular plans because that's how they make their money. Right? Example, there can be individuals, individual advisor who is doing his own practice. There could be bank representatives, relationship managers, or the brokerage house representatives. Right? Now, there's a conflict of interest when it comes to banks and the brokerage house executives. Now, anyone who is working in a bank and doing this, please don't take it otherwise. It's not against you. It's about the structure of the industry. It's not your problem. It's not your fault. It's the structure of the industry. What's the problem is, when you're dealing with the relationship manager of any bank for your mutual fund portfolio, there is the interest is not aligned. Why is it not aligned? Please understand, all these people, all these executives have got targets to achieve. They have some other research team who does the research, and they tell them this scheme you have to sell, and you give them target. The branch manager or the branch will give the target that every month you have to sell schemes worth this much, or every quarter you have to sell this, get business worth this much. Right? Now, when they suggest you something, I'm not saying they're suggesting something wrong, but the point is, after 3, 4, 5 years, when you look at your portfolio and you realize you have not got returns, that person who suggested you that scheme would have gone to some other bank, some other company, some other city, some other country. Who would you held accountable to? The new manager will come, he will say, oh, that guy was not good, he gave you some wrong policies, now I will manage your portfolio very well. So this is the problem. There's a clear conflict of interest. Why? Because their career is not dependent on the returns in your portfolio. Whereas when you're dealing with someone individually who is doing his or her own business as advisory, their interests are aligned with your interest. Why? Because they will grow their business only when you make money in your portfolio in the long run. Long run means 5 years plus. I just told you, you should be investing in equity mutual funds or stock market for 5 years plus only. Don't judge them every year, right? So their interests are aligned with your interest. They will get more business from you when they give you returns. They will get references from you when you give them returns. So there the conflict of interest is not there. But when you're dealing with an employee of a company, even though the employee would be very honest and with all the integrity and everything, he'll be skillful and everything, but the structural problem, because of the structure of the industry, the interest is not aligned for sure. They will fulfill their targets, get their commission, bonus, promotion, whatever, and move to the next company. That is the problem. So look at who your advisor is. Are your interests aligned? It's very important, right? Another kind of advisor by license is called SEBI Registered Investment Advisor, SEBI RIA. We call it RIA in short form, right? Now they will make you invest in direct plans, and they will charge you fees and commissions separately. So they will say, you are coming to me, there's a one-time fees of, let's say 10,000, 20,000, whatever it is, or maybe annual fees of so and so, and plus maybe there is a commission also, a very small commission percentage wise on your total portfolio size. So that varies from RIA to RIA. So you have to figure out what are they charging. That also depends on what their performance in the past has been. But they will make you invest in direct plans, and they will manage everything of your portfolio in their office. They have a team. They will manage everything in their office, all the back office work, all the advisory work, everything they will give you. They will make you invest in direct plan. You will save 1%, but out of that 1%, a small part of that or a chunk of that will go to them as a fees or commission. So that's a license called SEBI RIA, right? Another license, which by the way I have got, but I don't deal in mutual fund advisory. The license is called SEBI Registered Research Analyst. By the way, how do you find these people? Just go on Google, type SEBI Registered Research Analyst, SEBI Registered Investment Advisor. You will get the first link of SEBI website. Go there. All the list of registered advisors is there, along with their email address, their phone number, and their mail address. Yeah. Now, SEBI Registered Research Analyst can only charge you a fees, a fixed fees, and they don't give you any other service. They just charge you a fees and give you the list of portfolio which you should have, list of schemes which you should have. You have to do the buying selling at your end on a platform. I'll tell you about the platforms in the next slide. But you are supposed to do all the actions in your portfolio. This guy will just charge us fixed fee and tell you the name of the schemes which you should invest in. And whenever there is a change, he will tell you with this change you have to make. It's like going to a doctor. Whether you are a billionaire or millionaire or a rickshawala, the doctor will charge you 500 rupees fees in India, for example. Right? And then you are supposed to take medicine on time. You are supposed to do exercise on time. Right? So similarly, whether you have a portfolio of 5 lakhs or 5 crore or 50 crore, SEBI registered research analyst will only charge you a fixed fees. And then that's the only revenue he has got over. And you invest in direct plan. So let's say you have a portfolio of 2 crore, for example, and you're investing in regular plan. That means you're paying 1% more. That is 2 lakh rupees more per annum. Instead of paying 2 lakh rupees, you can go to a SEBI RA, SEBI registered research analyst, and pay them a fees of maybe 10, 20,000, whatever it is. And instead of paying 2 lakh rupees in the regular plan. But having said that, you have to do everything on your own in the back end. Then that effort will increase to some extent. Yeah. Fourth kind of license, robo advisory platforms are there, not licensed robo advisory platforms. They also make you invest in regular plans, but they give you everything holistically. They appoint a manager for you. They make your risk profiling. They ask you questions based on your risk profiling and your needs and requirements and your goals. They suggest you which schemes you should invest into. They give you a very user-friendly interface on the website, on their website, and you can go and invest through there. So they give you all the support you need, but it's a online thing. It's not a physical person who is dealing with you one-to-one. So there are examples like Scriptbox, My Universe by Aditya Birla Group, Funds India. There are others also. So they make you invest in regular plan, but you're not dealing with an individual person. You're dealing with a company rather. Right. So these are the 4 kinds of services you can opt depending on your requirement. Right. Now, if you say you want to invest in direct plans, let's say even in case of SEBI registered research analyst, they will charge you a fees and then you are supposed to do all the action, right? So where do you go? How do you buy? So these are the options. Look at this. Again, this is not an exhaustive list, but with a few names which comes to the top of my mind because they're doing well. We have Kubera, Grow, Zerodha Coin, Paytm Money, ET Money, Goldwise, Clear Funds, and IND Money. Very user-friendly mobile apps and websites. You go and create your portfolio there. You can import your entire portfolio of your family and yourself at one place. So everything will be visible at one place. You can start your SIP there. You can, stop all the SIPs everywhere else, stop all the investments everywhere else, and start your SIPs, instructions from here and start investing. So everything will be at one place. And you can, continue to manage the way you want to manage. Right now, another natural question which comes is, if they're making you invest in direct plans, these websites, and not charging you anything, how are they making money? How are these websites making money? Right. So the answer is, first of all, they are funded startups. They just want more customer base right now. Some of them have now started coming up with their advertisements on their website and maybe their advisory services, for which they will charge. So that's how they will make money in the future. But their platform per se most likely will remain free for very long, if not ever, if not forever. Right. Next natural question can be, how safe is my money with these platforms? It's completely safe, in my opinion. Why? Because these are just platforms. They don't own your investments. Let's say you're investing in Kotak mutual fund scheme. Your money is with a Kotak mutual fund company. Your money is not with Kubera or Grow or Zerodha Coin. They are just platforms, just dashboard where you can see your portfolio. That's all. And you can do your buying and selling there. You can do your SIP there. Let's say Kubera closes tomorrow. They're out of business. Your investment is totally safe. Why? Because you can then go to Grow, again create your profile, create your account, and import all your data there and start investing through them. It's just a platform. Simple. Yeah, makes sense. Let me look at a few questions. Is there any additional benefit in holding mutual funds in Demat form? A lot of people ask me this, Kanan, but I'm not sure if there is any benefit. I mean, I don't see any benefit. In fact, I think in case of index, in case of direct mutual funds instead of Demat account, the facility of SIP, SWP, STP is there. In Demat form, I think that facility will not be there. I'm investing through a bank's portal myself. How do I know the charges? They are charging platform fees. Still, they charge the commission. Tarun, most likely they are making you invest in regular plan. So they are charging you platform fees also, and they are making you invest in regular plan also. You're paying double the money. Most likely. But just find out from your relationship manager. They will tell you. Or just go on Google. You will get the answer. For example, ICICI Securities, SDFC Securities, Kotak Securities. If you're talking about these banking portals, you are investing in regular plan. And they are all traditional brokers, traditional companies, and they are charging you way high, commission, platform fees bhi le rahe hain, regular plan mein bhi invest kar rahe hain. That's like paying double money. What is the rationale for going through mutual funds route as opposed to investing directly in stock market, assuming that I have some knowledge on monetary movements and make some positive returns? So the point is, if you are confident on your stock market stocks in your portfolio, go ahead with stocks. But there is, a well-researched stock portfolio might give higher returns than a well-researched mutual fund portfolio. But the efforts required to create a well-researched stock portfolio is way higher than the efforts required to create a mutual fund portfolio. And when you say some knowledge, it should not be some knowledge. It should be complete knowledge. Half knowledge is more dangerous than no knowledge. And by the way, last 1 year, everyone has made money. So please don't get influenced by the market given the last 1 year performance, right? Can SEBI registered IA buy and sell on behalf of investor? Yes, Shankar. So you give them authority to buy and sell on your behalf. They do everything on your behalf. You give them that control, but you can always take away that control from them whenever you want. So that's how they can serve you, when they have complete control over your investments. Right? How easy it is to register on these platforms, especially NRIs, should not be a problem, because all platforms are actually very user friendly and very competitive. And I know NRIs who are investing in mutual funds using these platforms. It would not be as easy for an NRI maybe compared to a Indian resident, because the kind of documentation required is more. But I believe they have enough infrastructure to help you with that. Do these platforms send you monthly reports, etc., that can be accessed? You can, Suresh, you can access this online. They will not send you monthly. You can watch it every day you want to. Just go open your mobile app, open your maybe a laptop, and just look at your portfolio whenever you want to. Some schemes do not mention regular or direct. How to know? So most likely, if the word direct is there, then the scheme is direct. Otherwise, it is a regular scheme. So they mention the word direct in the name of the scheme. If there is nothing mentioned, it is a regular plan. Do we need to track invested index funds on regular basis? With your index fund is something you might not need a regular tracking, but usually if you're having a mutual fund portfolio, you should track once in a year. Monitoring should be once in a year. I'll take a couple of more questions, then we'll go to the next topic. While these direct platforms can be used for buy and sell, the secured information like bank accounts are on this platform. How safe to have bank accounts on this platform? So Bhaskar, so if you are, let's say, not investing through these platforms, but you're investing through an advisor, or you're investing directly through hdfcmutualfund.com or kotakmutualfund.com, your bank information will go somewhere or the other for sure, right? Talking about how safe it is, I mean, in whatever I have seen so far, heard so far, and given the SEBI very tight regulations, it's not easy for anyone to do anything hanky-panky. I mean, having said that, anything can happen, but I have not heard so far any cases against any of these platforms. I'm not vouching for any of them, but I'm saying I have not heard cases against them that they misuse any kind of personal information, because they are highly and heavily regulated by SEBI. Yeah. How to transfer existing funds from a bank held demat account to one of the platforms you described? So it's very simple. You don't have to transfer. It's not transfer. As I said, neither ICICI Securities owns your portfolio, nor Kuvera or Grow owns your portfolio. It's just a dashboard, right? So first thing what you do is you stop your SIP wherever you are doing. Stop your SIP. Open an account with Kuvera, Grow, wherever you want to open. Create your account, and there's an option called import your data. They will tell you step by step. It's very simple, very user friendly. Import your entire data there. It's like importing data. It's not transferring amount. It's importing data. You're just getting information seen there, right? Import your data and start your SIPs from there. So you'll stop your SIP at one place, started your SIP at new place, and you can't continue investing. But having said that, to convert from regular to direct plan, it's called switching from regular to direct plan. It is considered as sell and then buy as per income tax law. So you have to pay that short-term or long-term capital gain tax, and also exit load if applicable. So please be very careful. If you're moving from regular plan to direct plan, it will be considered as selling and then buying a fresh funds. So if you're selling mutual funds worth, let's say 50 lakh rupees with a profit of 10 lakh rupees, you have to pay 10%, let's say long-term capital gain tax of 10% on that 10 lakh rupees. Yeah. So be very aware of the tax implication of shifting from regular to direct. It's a one-time tax implication. Going forward, you can save that 1%, but you should be aware of that. Any recommendation on which platform to use? George, all these platforms which I'm listing here, they're all very competitive. Choose whichever name you like. Don't worry that whether Koira is better or ET Money is better or Zerodha Coin is better. All are very, very competitive. All right, let's move to the next topic. Okay, before I move to the next topic, is it making sense? With the next topic is the last topic. Just write a few yes in the chat box. Is it making sense? Are you getting what I am trying to say? Is it registering? Is it adding value? Yeah. Okay. Perfect. Quite a few people said yes. Thank you for that. Awesome. Thank you. Let's move forward. Next one, a very interesting one. Fund manager. Fund manager is the person who is the topmost guy of a particular scheme. So when you're giving money to a particular scheme, there's one guy called fund manager, or there can be two fund managers also in a particular scheme. He or she is responsible for taking the final call of that scheme in terms of what stocks to invest in and in what proportion. Right? So they have a team of people who do the research, but the final call has been taken to be taken by fund manager. So he or she is the one responsible for good or bad performance, either of the cases, right? Now, skin in the game. Skin in the game is nothing but putting my own stakes in the game, putting my own investment in the game, in the scheme. That's called skin in the game. I told you initially, I would want my fund manager to have some stake in the scheme which he is managing. Because if he is not putting his own investment in that scheme, that makes me a little uncomfortable. That shows me maybe he's not that confident on his research. He's not that, he does not have that conviction in his own research, right? Now you might say, they might not have enough money to invest, then what? To tell you, to give you a perspective on that, let me ask you a question. All of you write in the chat box. What do you think is the salary of a fund manager in India, including bonus, incentive, everything, per annum? On a per annum basis, what do you think is the salary of a fund manager in India today? 5 crores. Okay, what else? Anyone else? 2 crores, 25 lakhs per annum salary, right? 1 to 2 crores. Okay, what else? 3 crores. Looking for more answers. What is the salary of India, the fund manager in India? 1 crore, 20 lakhs, 50 lakhs, 2 crores. At least 1 crore. Okay, let me give you the answer. Most of you are very close. It is anywhere between 2 crores to 10 crores in 95% of the cases. It could be more than 10 crores in exceptional cases also. But it can be below 2 crores when you are a new fund manager. When you have just entered the industry as a fund manager, you have no experience, you have no prior experience. So maybe in the initial 3-4 years, your salary will be between 50 lakhs to 2 crores. But it is bare minimum 50 lakhs, even for a newbie fund manager. And within 3-4 years, it will cross 2 crores. Now tell me, do they have any excuse or any reason for not investing money in the scheme which they are managing? No, right? I mean, I'm not saying invest lakhs and crores of rupees, but invest some money at least, right? Yeah. So let's go forward. So there are 3 categories of people within a mutual fund company. There's something called key managerial personnel, that is the senior management of the company, of the mutual fund company. Then you have the fund manager of the scheme, and then you have AMC, board of directors. AMC is what? Asset management company or the mutual fund company, simply. So these 3 categories of people are very important for any scheme or the company. And I want to see the investments done by all the three people put together. Why put together? Because it is a board of directors and the other senior management who hires the fund manager. So when they have their own stake into that scheme, they will hire the fund manager in the best possible manner, right? So I want to see the skin in the game for all these 3 people put together, right? And you can find all this data in something called scheme information document. This is something which is released at least once in a year by every mutual fund scheme. And it's like a 100-200 page document in which you just need to find this one table which talks about the investment done by these 3 people put together, right? Let's look at one of the examples. Edelweiss large cap fund. Let's look at the investment done by all these 3 people put together in this particular scheme. So this is I'm just directly opened this. I'll show you one example of how to find SID in the next example, but right now I've just directly opened the SID of this particular scheme. There are some keywords. So one of the keywords is aggregate, because you can't just go through 119 page document, for example, in this case. So I'll write the word aggregate and let me enter a few times and let me go to that table which gives me my answer. Look at this. Look at this table. This is as on 31st March 2021. Total investment by AMC board of directors nil. Investment by fund manager 17,600. Investment by other key personnel 17,600. By the way, they have mentioned the exact same amount for both the categories. I think this is a error, or this is a intentional mistake which they have made. It should they must have mixed the 2 things together. It cannot be same investment exactly in paisa also, right? So total investment is not 34,000. Total investment is 17,670, which is very less, which is like almost zero, right? Let's look at another example to give you a perspective. The scheme called DSP Mid Cap Fund. Let me go to Google and show you how to find it. DSP Mid Cap Fund scheme information document. I just enter this, and preferably I would want to go to the company's website to find this data, right? So let me enter along with this 2021. That gives me a better thing. Let's go to this link. No, not this, sorry. Let's go to the website. Now, this actually is a bit typical to find the SID of a company, of a scheme, which is the latest date, because sometimes you find SID dated 2019, 2019, 18, 16. So you need to you need to look at the SID, which is the latest one. And sometimes it's not that easy to find. Let me see if I can do something here. usually you find something called downloads button, where you can get this data. I'm looking for scheme information document keyword. Maybe I find that. If I don't find that, maybe SID. No, it's not there. Download is there. No. Typical find, but we should be able to find something. No, this is just giving me the list of schemes. Let me go back to Google. DSP Medcap. There's another website from SEBI, which also lists the SID, but usually that document is old. Usually, not always. So I can also go to SEBI website and find this data. But I prefer to go to the company's website, preferably. So let's see what they have. By the way, let's see if they have the latest one. Midcap, DSP Midcap Fund. Again, find the word aggregate. Okay, this is not very new, but not too old. Look at this. This is as on 31st March 2020. I'm sure there will be 2021 also, but just for the lack of time, I'm not going into the research, but you can find on Google, you will get this data. But look at this amount. This is close to 13 CR. 13 crore rupees has been invested by all these three people to put together. Now, it doesn't mean I'll go and invest in this scheme just looking at this. Please don't take anything like here as a tip. And there's no one single parameter which will tell you that go and invest in the scheme or go and reject the scheme. No, it's a holistic view which you have to see, right? So as per this data, it looks like they have invested a significant amount, and it's quite comfortable for me. Yeah. So, but don't go and invest in this scheme just based on this, because there is something called integrity, which I can see from the amount of investment they are putting in. There is something called capability. So if you look at Motilal Oswal mutual fund schemes, most of the schemes have got good investment by fund managers, by all these three people put together, but they're not able to perform. So they are also losing their money. I will also lose my money if I invest there, if I had invested there in the last few years, right? So it's not that the higher investment means they will definitely perform. It's one of the parameters to look at, and it's a very crucial one, no doubt, right? All right, before I go to the next very interesting point, let me look at a few questions and I'll go to one. How can mutual funds deliver huge returns compared to Sensex or Nifty? Is it because of the churn in the portfolio? If they are making by churn of portfolio, will the expense ratio not increase? So see, index fund versus active funds, what's the main point? Index fund has got all the, let's say 30, 40, 50, 100 stocks in that index, right? So you're just copy pasting. Whereas fund manager in the active scheme is saying, I will choose the best 20, 30, 40, 50 stocks out of that ocean of stocks, and I will give you better returns. Not that everyone is able to do that, but there are cases when they're able to do that. So you have to find that and invest. What is the percentage considered reasonable by investment manager? So Mani, good question. Don't look at the percentage investment with respect to the total size of the scheme. Look at just the total investment. So that's a different, it's a long answer. I would not be able to maybe answer that right now, but you just look at the absolute number here. Okay, so fund manager investment. Is fund manager responsible for giving minimum returns? No, Gopi, there is no mandate by SEBI. Across the world, there is no such mandate in any country that the fund manager is supposed to deliver a certain minimum returns. No. In financial markets, no one can give you any guarantee of any sort of minimum returns. That's not allowed. Can you give insights on PMS? PMS is a different topic, Siddharth. PMS, you just go on Google and search. I mean, it has got both pros and cons. You can invest in PMS and mutual funds both, or maybe only PMS, only mutual funds. That depends on your risk appetite and your outlook. Is mutual funds better than equity? Again, there is no right answer. depends on your comfort level. I said the amount of effort you need to put into shortlist a portfolio of stocks is way higher than the amount of effort you need to make to monitor or create a portfolio.
Right. Okay. Thanks, Abhi. Thank you.
I assume opening accounts with these platforms will link to our NRE account, and with these platforms are capable of catering to NRE. So see, someone asked the same question a few minutes back. In my opinion, as per my knowledge, these platforms do allow NRI investments also, but you have to then maybe just figure out. Maybe some of them do not, some of them do. Going online on the website will give you the answer. What's the difference between IDCW and growth fund? IDCW is just a technical term for dividend plans, dividend plan versus growth plans. I just opened an account with Scriptbox. So Scriptbox is a regular plan. So just you should be aware that you're investing in a regular plan. I'm not saying don't invest. I'm saying you should be aware that you're investing in a regular plan, and you should be satisfied with their service for the charges they are you are incurring. Okay, now let me move forward another 5 to 10 minutes, 7 to 8 minutes I will take, and then I can take on more questions, and then we can go to the quiz which Ajay was talking about in the beginning. So all of you, please make sure that you take that quiz. I think there is some CPD points, something like that, some rewards you get out of that. So before I go ahead, a question to all of you, please answer me in the chat box. How would it be if I train you to gain mutual fund expertise so that you can fulfill all your financial goals? If you are interested to know about this, please write a yes in the chat box. Let me see how many of you are interested. I mean, it's not that everyone, it's for everyone, but if you are interested to know about this product, you can write a yes in the chat box. Okay, perfect. A lot of people are interested. Awesome, great. Let me move forward. Something called Mutual Funds Excellence Program. It's a 3 days live workshop wherein you shortlist mutual fund schemes during live session. By the end of the 3 days, you will have your portfolio ready with you, where you want to invest, how you want to invest, how many schemes, which categories, and all that. Right? You will know how to monitor your portfolio at regular intervals, how frequently you should monitor, and what you should look at when you are monitoring. So if you're already investing in a mutual fund portfolio, already, then you will know how to monitor that existing portfolio also. Right? When to sell. Now, selecting a mutual fund scheme is much easier compared to taking a decision of when to sell. So we'll talk about that, when to sell, in this program. And some of you might be investing in mutual funds through an advisor. And as I said, I'm not against regular or in favor of direct or anything like that. You can continue investing your money through advisor even after attending this program, but you will be able to have a more meaningful conversation with them. Rather than simply asking returns kitne aa rahe hain, how much returns am I getting, you will ask more relevant and meaningful questions. Why are we selecting this scheme? This scheme has these problems. Why are we not selecting that scheme? This scheme is good because of so and so reasons. So you can have a more meaningful conversation with them. Right? Now, I'll talk about bonuses in the next slide. You will get bonuses worth up to 6,000 rupees. There will be a dedicated WhatsApp group in which I will be there for 10 days. After the workshop is over, I will be there for another week on that group to answer all your queries. Yeah, and that group will keep on going. I will exit the group later on, but the group will be there for whatever time you want to be there. This is only on equity mutual funds, no hybrid or debt fund. So please be very clear. There is so much to learn in equity mutual funds, and if you just focus on that for 3 days, you will for sure gain expertise in that. So I will not be able to cover debt fund or hybrid fund in this program, because this requires this much of time. So these are the dates: 2nd, 3rd, and 4th of July. Look at the timing. This is Indian Standard Time, so please adjust it as per your Bahrain time. So Friday, Saturday, it is 8:30 p.m. Indian time to 10:45 p.m. Saturday, same time. Sunday, it is 4:30 p.m. Indian time to 6:45 p.m. So I believe your weekend is different there, so you have to manage something on the Sunday. You have to see how do you manage your work and attend the session on that day. If you miss the live sessions, you will get the recordings as well. So you can watch the recordings. You have the recording access for 7 days. For example, the program is getting on 4th of July. So you will have access to the recordings till 11th of July. That is next Sunday. So you have 1 week full with you to revise the recordings, watch the recording as much as you want to. Yeah, I'll come to the questions once I am done with this details. Then I'll come to the questions in the chat box. Now, this is the curriculum of the program. We'll start from starters. So even if you don't know anything about mutual funds, you will come at par with everyone else, right? Then we'll talk about how the tools which you need to shortlist mutual fund schemes. Then we will start shortlisting mutual fund schemes on day 2, and then creating your portfolio, how many schemes you should have, how you should allocate between them, how to monitor your portfolio, when to sell, taxation impact of on your mutual funds. Then we'll work on a sample portfolio. This is a beautiful exercise and the most valuable one. We work on actual portfolio, a sample portfolio, and see how do you take decisions of buying, selling, and holding a scheme, right? Then we look at other facts about mutual funds and how to choose your advisor and which platform to use. So all this is like the broad curriculum of this program. Now, this program is worth ₹1,999. I told about the bonuses which you will get for free. So this is one ebook you will get, which is on Mediclaim rejection. Another ebook you will get, which is on term plan, how to choose your term plan. Another ebook on how to improve your credit score. I believe this is relevant for if you have a credit card or a credit history in India. And there will be quizzes after every session. So day 1, day 2, day 3. After every live session, there will be a quiz, which will be a scored quiz and a timed quiz. The scores of all the 3 days will be added, and the top 10 scorers after day 3 of all the 3 quizzes put together will get ₹500 each as cash prize in their bank account. Right. So now all of this is worth ₹7,999, but you don't have to pay ₹7,999. If you go to my website right now, you can register for this program for ₹499. Right now you can do that, right? But since we are doing this association or doing this exercise with the Bahrain chapter of ICAI, only for next 20 minutes the price is ₹399. I know neither ₹499 is big for you nor ₹100 makes a huge difference, but just a small gesture from our side that you can register for this program for ₹399 till this program is running, till this session is running. Once the session gets over, I will disable this link. Right. So now I'm sharing this link in the chat box, and then I'll share a few more things, followed by I'll look at your questions. So you can click on this link, have a look at your chat box. Okay, I've shared the link now. You can click on the link and register for $399 right now if you want to. And in the meanwhile, let me show you a couple of things more. A couple of I would say testimonials from people. So Piyush is the MBA consultant, MBA admission consultant. He said he's talking about the content and the structure of the program, and he found it very simple. Vivek Gupta is a professor in IIM Lucknow, and he says it is recommended for everyone, be it a beginner or a pro investor. Kiran Reddy is an analytics consultant, and he says that he was overwhelmed by the number of schemes in the market, and he was blindly trusting the ratings given by all these mutual fund websites. But now he can confidently build his portfolio after the program, and he found the program very crisp and clear, the entire framework of choosing the mutual funds. Right. A very small video of about 5 minutes, 5 people sharing their views about the program, and then I will go to Q&A. Yeah, just last one bit, 5 minutes. Just have a look at this. Let me switch on the audio from here.
Hi, my name is Parth Nishal Trivedi. I'm currently in my last year of undergraduation in Bangalore. I'm a student of Anupam sir in his Mutual Funds Excellence program. The structure of the program was outstanding and the content was in-depth as well as crisp that even a non-investor will become an expert in understanding mutual funds after the program. The explanation and demonstration of building a sample portfolio has helped in getting a theoretical as well as a practical point of view. Anupam sir has been an exceptional teacher by sharing his honest thoughts and clarifying all our doubts with proper reasoning during the 3-day session. Post session 2, sir has been actively clearing all our doubts through WhatsApp individually and giving in-depth answers to each person. I would highly recommend the course to each and every person, despite being an investor or not. Thank you so much, sir, for helping me start my investment journey in such an informed manner.
Hi, my name is Vinayak Kini. I am based in Bangalore. I have been in the financial services industry for more than 20 years now. I have been investing in mutual funds for a long time, but one thing I have been in search of is a strong framework to manage my mutual fund investments, whether it involves the selection of a fund, creating a portfolio, reviewing the performance of my funds, or even exiting a fund. Anupam's Mutual Fund Excellence Program addressed exactly this need. In a world where there is an overload of information, it focused on the key aspects of making successful equity mutual fund investments through a robust and a repeatable process. He also emphasized many times during the program that discipline is the key to success. I encourage everybody, whether you're a beginner or an experienced investor, or you simply have a passing interest in equity mutual funds, to attend the program. It will enhance your understanding of equity mutual funds and make you a more confident investor. Thank you.
Hi, my name is Pooja Prabha and I work for City Corp Pune, and I did this mutual fund excellence program with Anupam, and I would highly recommend to everyone. It is a one-stop solution for all your mutual fund queries and understandings. I also highly recommend this for females because we generally rely on our male counterparts to take the financial decisions for us, and especially when it comes to investing, right? So this program really helps to get in-depth understanding of mutual funds, and you can just get kick-started from the day one. So I highly recommend this program, and thank you so much, Anupam, for having such platform for all of us.
Hello, I am Krishna Mohta, a mutual fund distributor and financial advisor from Akola, Maharashtra. So my review is going to be from a mutual fund distributor's point of view. Socrates was the wisest man in Athens, not because of how much he knew, but he was the only one who understood that how much he did not know. Now, as a distributor, I wanted to unlearn and relearn about mutual funds, and hence I came across this program of Anupam Brugta's Mutual Fund Excellence Program. A lot of information is flowing on in the internet, YouTube, but what is more important is knowledge, and hence go after knowledge and not information. And Anupam Brugta's Mutual Fund Excellence Program is one such program which focuses on knowledge and not flow of information. The program is brilliantly structured and gives a lot of clarity on a lot of mutual fund topics. Me as a distributor, I am very lucky that I got to go through this program, because now I am able to implement these strategies for my clientele, and I hope to see that I devise a nice framework and generate more returns for my clients. So this program is not only important for investors, but also for all the mutual fund distributors to become a better version of yourself. Thank you, Anupam Brugta, for such an enlightening program.
I am CA Akhil, working with a manufacturing company in Manama, Kingdom of Bahrain. Being a chartered accountant with an investment track record of more than 15 years with decent returns, I thought I knew most of the things about mutual funds. However, the 3 days Mutual Fund Excellence Program conducted by Anupam added new perspective to my mutual fund knowledge. It was well spent 6+ hours over these 3 days, where Anupam added new dimensions to my knowledge. He explained different ways to make our equity mutual fund portfolio. Thank you so much, Anupam, for the detailed analysis and your lucid explanations.
Thank you, everyone. So this is it. Before I, there's someone asking for the timing, so I'll just go to that slide and show you, keep that slide on, and then you can ask me questions, Q&A. We can go to Q&A after that. Okay, this is the one, this is the timing in front of you. And okay. Yeah, all the timings you can see is Indian Standard Time. So just adjust it as per Bahrain time and then see what works for you. Yeah. Thank you to all those for the trust who have registered. We have got quite a few responses. Thank you for that. Thank you for the trust. See, anyone, whether you're from Bahrain ICICI chapter or any other chapter, thanks to the Bahrain chapter, you can register for the program because you're attending right now. Since you're allowed to attend the program, you are allowed to go for this course as well. Is it good to invest in mutual fund mixed baskets and take leverage and trade in options? Hari, so I am not a fan of future options or leverage. I believe in simple investing for long term. So, I mean, that's what has worked for me. So since I have not done that, so I don't recommend that as well. I'm sorry, I understand some of the people are talking about Sunday timing. Unfortunately, we largely cater to the Indians who are in the country. So that's why the timing is as per, Friday, Saturday, Sunday, it's a weekend. But as I said, you have recording available, so you can always watch the recording over the next 1 week whenever you get time, and I'm there with you for the entire week after the program to answer your queries. So you can figure out that day. Can mutual funds and stocks be bought and sold from these platforms? So Demat account is with the platform. I think absolutely depends on which platform you're using. I mean, just figure out right now from your RM or whichever platform you're using. So, for example, Grow has an option for both in mutual fund and stocks. Some have, some do not have. So you have to look at which has an option. Is there any way to research how much component of fund manager remuneration is linked to the performance of a mutual fund? Yeah, Uday, first of all, the answer to your question is no right now, but it's not linked. So it varies from company to company. We don't know how much bonus and incentive they're paying. But good you asked this question. By the way, the good news is in April 2021, hardly a couple of months back, SEBI has come up with a new regulation according to which whatever the salary of the fund manager is, 80% will go in cash in their bank account as it was going. The remaining 20% has to go in the form of units of the mutual fund scheme which they are managing. And this is a huge transformation which can happen in the mutual fund industry in India. It's a great news. Assuming it is implemented the way it is meant to be implemented, assuming they don't come up with some loopholes or some manipulations in that. And they cannot sell those schemes for 3 years. It's a lock-in of 3 years. So now they will mandatorily have skin in the game. Yeah, so that's a great news for the mutual fund industry in India. If it is implemented the way it is meant to be implemented, I believe the returns we can see in future in mutual funds in India would be better than what we have seen in the past. Challenges subscribing to mutual funds is executing the documentation. Some of my friends have suggested a net banking route channel. Can you kindly advise which is the best option to go about this? Sivaram, you're asking about MFEP program. You're asking about generally investing in mutual funds. I didn't get your query. So you have to go with net banking for this, or maybe you need to have a debit card or credit card of India for this payment link. Sorry, the foreign bank is not possible for this particular link. You don't have that facility, unfortunately. Yeah, investing in mutual funds. Yeah, see, understand compared to Indian investing, a domestic, domicile in India investing in mutual fund and NRI investing, their documentation is more. But it's just one-time documentation. It's not that every time you have to do it. Once you have your portfolio set, then only when you're changing some scheme once in a while, then you have to do the documentation. That's also not every time. So it is a little bit of effort, but it's not that it's not doable or not attainable. What is the best time to sell mutual funds? So Srinivas, there is not one direct short answer. Again, if you have enrolled for this, this will be covered in the MFEP. When to sell is a very important question, and so it is important to enter into the right scheme. It is equally important to exit that scheme at the right time. No doubt about that. I have only few years of work life, and I have unfortunately missed SIP route, but I have some lump sum disposable surplus, which schemes to invest in lump sum mutual funds so as to satisfy my retirement. So see, Sairam, whether you have lump sum or SIP, whatever it is, whether you are investing in past or not investing, there is no difference in what you choose. So if I have to choose good mutual fund schemes, whatever my age is, whatever my requirement is, everyone would like to invest in good mutual fund schemes, right? So there is no particular customized schemes you need for that. Yeah, for your financial planning overall, what do you need to achieve? What are your financial goals? How much you need to spend, and how much you need to save and invest? That is something what a financial planner can do. That is something not maybe I can guide, because that's it's a huge industry in itself. Is it advisable for short-term profits on mutual funds? So it's not advised or not advisable right now. In last 1 month, 1 year, 6 months, people have made money, and some of them are booking profits, but that's not a good way to go along for a very long. I mean, that will not give you good returns in the long run. You will not create wealth that way, or you will not fulfill your financial goals that way. You have to keep on investing in a scheme if it is giving good returns. You don't exit a scheme just because, and by the way, this is a very good question. This is again covered in MFEP. When we talk about when to sell, we look at this particular aspect. A very good question, Kanan, that If I have made profit in a scheme, should I book profit and go to the next best scheme or another good scheme? So that's a very pertinent question, but there's no one line answer to that. I'm sorry, there's some of people are asking they are not able to pay because it's not allowing them to do so. You have to have some maybe talk to your friends or maybe people in the same group. Maybe they can pay for you by writing your name and email ID and phone number, and you can pay them separately. Maybe they can register you. Yeah. Unfortunately, we don't have the international option available on our website. Ravi is asking, can you look for the individual portfolio and give your opinion? Ravi, I'm sorry, I would not be able to do that for two reasons. Number one, you are doing this program so that you become independent. If I am supposed to give opinion, then the purpose gets defeated. Number one. Number two, being a SEBI registered research analyst, as per the regulation of my license, I cannot do customized advisory. And you will not need customized advisory after this program. Your portfolio will be transformed. I have no doubt about that. There's like hundreds of people who have done this program. Is the sessions available for future viewing? Sivaram, yes, the option is available. As I said, the recordings will be available whether you attend the session live or not. You will have access to the recordings of the program, right? So, and the recording will be there for 1 week. That is, the program gets over on 6th of July. Or 4th of July. So the 11th of July, the recordings will be available. Then the access to the recordings will go. So you have to watch it within that 1 week. Thank you, Chinmay. Thank you for the feedback. Thank you to all those who have registered. Thank you very much. Yes, for this session, Sivaram, no, for this session we are not sharing. Okay, this session recording is available with the Bharian chapter, by the way. So yeah, you have to ask them. I think they will be sharing the recordings, if I'm not wrong. Okay, Mahesh Kumar is asking, I did a SIP of 5,000 rupees and the value of investment is 4,999.63. What is the shortfall meant for? This shortfall is expense ratio, Mahesh. I told you expense ratio is, let's say, 2% for a particular scheme, but they deduct every day. So 2% divided by 250 working trading days are there. So 0.008% is deducted every day. So that shortfall is because of that, and plus there are other taxation and other charges also. Okay, so Ajay is just mentioning the president for Bharian chapter. This session is also on my YouTube channel. We are also live on YouTube right now, and this will be there on YouTube channel also. Will you tell us which are good mutual funds after 3-day session? Vakar, you will have the portfolio ready with you after 3-day program. Don't have to tell you. I will tell you how to do it, and you will do it practically live. I will do it in front of you, and everyone will create their own portfolio as per their need and their requirement. And you will have, I will be there to answer your questions. So you will have your portfolio ready after this 3-day program. That's the bottom line. Sumit, so I don't think so Paytm option is available. So when you go to this link, in the payment option, they give you option for wallets. I don't know what all wallets are there. I'm not sure if Paytm is there as one of the options. Will you be covering which mutual funds to invest in international equity market? Sairam, this is only for Indian equity market mutual funds. So international market is, again, there are Chinese funds, there are US funds. I will share my views on international equity market, by the way. I will do that, and I'll tell you why not or why you should invest there. But we will not be selecting those schemes in the process. We'll be selecting only the Indian equity mutual fund schemes. So Chinmay is saying he paid through Google Pay. Someone was asking about, Sumit was asking about Paytm option. So Google Pay option is there in that link. 3-day session only for freshers or benefit others too. So Kanan, you must have seen this testimonial of people or the video testimonial. So a lot of them said it is equally beneficial whether you are a fresher or a, even if you are a pro. I mean, there are, in every session of mine, there are at least 8 to 10 mutual fund advisors or distributors or investment advisors who are registering. And they have given me, by the way, one of them was a mutual fund distributor advisor who gave me the, this testimonial. So when the advisor is attending and finding value, I am sure even an investor will. Jitu, if the payment is deducted twice, just write an email to us on info@anupamnoonta.com from where you have got other emails. We will refund the money. Don't worry. By the way, all those who have registered, you will get an email from info@anupamnoonta.com, check your promotions and spam box if you have not got an inbox. That is welcome email with all the details. It also has got a WhatsApp link to join that exclusive WhatsApp group for this program. Make sure you click on that link and join that WhatsApp group. But do check your promotions and spam box if you have not checked yet. Okay, Ankur and Ajay, I think more or less we are done. Maybe you can take over, or if you have more questions, I'm ready to answer more questions. But maybe you can do a quiz, or if there are more questions on this program, I'm there for another few minutes.
So thank you so much, sir, for such an enlightening session, and it was really helpful for all of us. It was really very knowledgeable and insightful, since most of us have been invested in mutual funds, or rather willing to take up the mutual fund investment in future. So Honorable Chairperson, C.A. Ajay, eminent speaker, sir, and dear members, now it is the time to express gratitude to all of those who have made this event a grand success. I would like to thank you all on behalf of Bahrain chapter of ICAI for gracing this event with such enthusiasm. We wholeheartedly thank our speaker, Mr. Anupam Rungta, for addressing us in today's event in spite of his occupied schedule and enlightening us about such a crucial topic for all of us, which is very important. I thank the chairperson, C. Ajay Kumar, again, and all the EXCOM members for their untiring efforts in seamlessly organizing this event. And at last but not the least, we thank all the participants for this event for joining us with great enthusiasm. With this, let's take up the quiz. I hand over the control to CA Natasha with the Kahoot quiz. So let's play the game. Over to you, CA Natasha.
Thank you, Ankur. Am I audible?
Yes, you are.
Yeah. Okay. Let me just share the screen. Okay. Is this visible to everyone?
Yes, it is.
Yes, it is.
Okay. So you know the drill. You have to put in your membership number followed by your name. And, this is the game pin 8311311.
I should not participate, no?
I can vouch for the confidentiality, so you can participate if you want.
Josefa, the first name and the membership number. If you can exit and join back again, Josefa.
Josefa, again, can please join with your membership. Please join with your membership number.
I see some members are still registering only with their name. So if you can just add first name and membership number, otherwise we won't be able to identify.
Yeah, and even someone's just put their membership number. If you could just put your name as well.
Which might still be okay then, but just having the first name.
We'll wait a couple of minutes. As Tickmaster Java. Okay, I think I have a good number. Can I start? Is there someone who's still trying to join? Please, if you could. Okay, so we'll start now. Yeah. This is the first question for the day. It's a simple true or false question. At the beginning of the session, our speaker of the day, Mr. Anupam, shared 3 secrets of mutual funds. Is it true or false? Oh, it's a very good number for the right answer. Mayank, Parimal and Garvita on the top, Rohana and Deva Kumar following them. Second question, Mr. Anupam has been helping people with investment strategies for how long? This was there in the profile shared in the message as well. Over 15 years, over 12 years, over 10 years. Oh, looking at the session, I think people have a lot more confidence on the number of experience. Okay. I don't know who this is. Gaurav on top. Next question. While shortlisting mutual funds, the performance older than 10 years is most meaningful. True or false? Okay, this was the second secret. Somebody is okay, not much movement there. Mutual fund distributor and SEBI registered research analyst are two of the types of mutual fund advisors discussed today. True or false? This is coming in very fast. People have been very attentive. Okay. Let's see if there's any movement. The top 5 doesn't seem to be changing. Okay, this is a multi-select. Which of the following categories were listed today as ones to avoid while shortlisting mutual funds? Select all that applies. Okay. All right, over to the next question. All of them were right, by the way. The expense ratio for a direct plan is always higher than a regular plan. True or false? Oh. All right. As attendees today, we can avail a special offer for a 3-day live workshop. What is the name of the workshop? Mutual Funds Success Program, Mistakes to Avoid in Mutual Funds Excellence Program, Mutual Funds Shortlist Program. Okay, very few who have got it wrong. Okay, so that's all the questions about the session today. The last two are from our BCSE treasure box. What is the theme for June? Health and well-being, the joy of giving, yoga at every home, Surya Namaskar Challenge 2021. Great. Okay, no movement whatsoever. And the last question, during the chairperson address for today's session, the annual family day was announced. When is this scheduled? July 1st, 25th June, July 16th, June 24th. The annual family day. Okay.
So
That
just a
brings
reminder
us
for
to the
everybody,
end of the
16th July, please mark your
16th July. Ajay.
So that will be disqualified anyways, like last time. But I
Yeah.
participate for the
Yeah.
fun of. I was also listening very intently to the session, so I just wanted to check myself. Thank you. But amazing session, Anupamji. I think it was very well attended, and I could see the attendance was very high right throughout the session, 185 plus, I guess. So I don't know if you can see a statistics of how many people have registered, but I do guess a lot of people have registered. I think it's a really people look for value for money. I don't think there can be a better value for money. I think there are some constraints, obviously, and we did discuss about doing an exclusive session, but I think members should also understand that for when he's arranging a session for such a very competitive price, so he has to have volume, which as BCICI we cannot guarantee at this stage. So therefore we are allowing you to join for the general session, but since, like he mentioned, we will have a recording available, so that should be fine. And like he said, is available for a week afterwards, if you watch the recording, and then if you have any doubts, etc., you can join. So I guess people will avail this opportunity to participate in the session. And then I believe he has other sessions as well, which probably it's like one step at a time. So with this session, how he's how his speaking style is, how he's covering the topics, etc. So maybe with the next session you will better understand his longer sessions, how does that go, and then you can take it from there. So I really want to thank Anupamji once again for a fantastic session. I think you mentioned at the beginning of the session that whether we have made the right choice or wrong choice inviting you to speak. I do believe we have made the right choice, having listened to the whole session. So thank you so much for that, and thank you. So thank you also to Ankur and Natasha for handling the admin work at the back end, and of course Sharmila, who has always been the person who's been managing the logistics with Anupamji's team. So and thank you for all the members, and also from the non-BCSA members who participated. I could see people from Kenya, Dubai, and all those other chapters as well. So so thank you so much for joining for today's session. So with that, probably I think we are now ready to close the session. And so I just wish you a reminder of a wonderful weekend, whatever is left of it. So thank you so much, and enjoy your day. Bye-bye.
Thank you, everyone. Thank you, Ajay. Thank you, Natasha, Ankur, and Sharmila for arranging and all that. So please, thank you for attending. I mean, it extended quite a bit, but people were there. So thank you for that.
Yeah, somebody was suggesting another 30 minutes. So,
yeah, I saw that.
Thank you so much.
Thank you, everyone.